Hello and welcome to the Movie Market Podcast. I'm J.R. Gondeck, and as always, joined by David Sokolovsky. David, let's review the third quarter and September and a little outlook to the fourth quarter and beyond.
Sure. Thanks, Jared. So third quarter was a very exciting one in terms of, economic activity and market performance overall. We saw some changes that we were expecting to see sometime this year, and it's starting to play out a little bit. So you saw the equal weighted S&P index, start to outperform the S&P by about 3.5%. And then you saw value outperform growth by about 5% as markets began to rotate. Another area that did very well over the quarter was small cap and international as well. So just starting to see some different leadership emerge within the market, and it's not going to be all tech and all growth as we look ahead, but you've seen some of that rotation. And these have been the strongest first three quarters of the year for the S&P since 1997. Again, S&P having a strong year. In general, the markets are up, and now the question is, where do we go from here? Looking on the other side, at bonds, you're seeing, again, very strong performance on the aggregate index. And really, as interest rates have come down, you've seen some of the prices on those bonds move up. So if you had longer duration in these couple of weeks, it's helped you. Outside of that, it really hasn't been very much of a help to portfolios. And if you look at the impact of interest rates, it really has been some pretty dramatic moves. So the Federal Reserve cut interest rates for the first time in a long time in September. And so you saw interest rates move, 50 basis points on the short end in some cases. And, and the 1 or 2 year rate, you've seen interest rates come down by over 1%, which again is a very, very significant move. So with that as kind of a recap, JR, and looking ahead, what's the Federal Reserve looking at? How many rate cuts should we expect? What are the key drivers of economic activity that they're focusing on?
Well, David, the Fed really did surprise the markets by going 50 basis points, right? I mean, there wasn't a lot of talk by any of the Federal Reserve governors kind of ahead of the meeting. And to almost be unanimous was a little bit of a surprise. So it really begs the question, why did the Fed do 50 instead of 25? And to your point, what is the Federal Reserve looking at, right? And if you look at the three big areas of focus for the Fed at this point, you have inflation overall, which is the first chart we're looking at. In inflation, they're pretty comfortable now that we're on a clear path to 2% over the next few quarters, right? And we have a favorable data point coming next week as well to kind of confirm that trajectory and trend in inflation. So for the most part, from the Fed's point of view, inflation is off the table as a concern. The economic stability and growth remains strong, almost 3% second quarter GDP growth. And here at the end of the third quarter, based on the Atlanta Fed, we're projecting right around 2.5%, which could go up or down a little between now and the final data point. But the real focus is the labor market. And that's what the Federal Reserve has been concerned about and was their rationale for doing, a 0.5% cut instead of just a quarter. And over the last few months, including this morning, you have okay job growth data, but it's substantially slower than it had been. And it's really the concern of the Fed, because that there is a slowdown in the economy ahead. And if you think about the labor market slowing down, that could be part of the reason, David, right? As the Fed, if job growth really slows or goes to zero or a little bit negative, that could lead to a slowdown in the economy or an ultimate recession. So to me, it felt like the Fed wanted to go 50 to support the labor market to hopefully have a little bit stronger job growth ahead. And, knowing that the effects of a rate cut take, many quarters to actually be felt.
Yeah, Jared. So as the Fed kind of starts cutting rates and as we look out, we're expecting more rate cuts this year. But, I would say that the gap between where the market is and where the Fed is has really narrowed as far as expectations for, rate cuts looking ahead. So as we look out to the rest of this year and as we look ahead into next year, you have the blue line, which is the Federal Reserve projections, and then you have the orange line, which is the market expectations. And just a month ago, the Federal Reserve, before the most recent dot plot, was expecting to be in the 4% range at the end of 2025. Now they're in the 3.5% range at the end of 2025. But again, as you can see, expectations are for ongoing rate cuts through the end of this year, and then again continuing next year with a rate cut every meeting or every other meeting in some cases. So again, the support from the Federal Reserve is there. The question is, if we have more of a slowdown, do they step in and intervene further? But
Well,
yeah, I guess as we look ahead and as we see ourselves firmly moving towards an area of lower interest rates, what are some of the areas that you expect to benefit? What are some of the impacts that we've seen, for example, with with the Fed cutting rates? I'm assuming as soon as the Fed cut rates, everything moved down across the board.
well, you think about the impact, David. We've had many conversations with families and people over the last few weeks, and along the Federal Reserve rate cut. And one of the big issues is cash, right? When money markets hit 5% and the Fed was above that, that 5% just seems like a headline trigger number to pull a lot of people to move. And 5% feels like a high rate of return to earn on your cash. So there's a lot of movement over the last year taking advantage of that. And that was that higher for longer policy by the Fed. Now, as we navigate totally different, and as you said, we're looking at 7 rate cuts priced in the market by next summer. All of a sudden, that cash holding that was 5% is now in the 4s, has a path to the 3s or 2s. So all of a sudden, there's a different conversation with people looking to move their cash. Is it going to go into real estate? Will it go into the stock market? Will it go into dividend stocks? Right? There's just going to be a lot of movement of reassessing cash holdings. Do you extend duration, with your cash holding and lock that yield in a little bit longer? There's going to be a lot of movement, with cash out there. The other areas that have benefited, like I mentioned, dividend stocks, as you get lower yields, all of a sudden, dividends are attractive. And as you mentioned earlier, utilities are one of the best performing sectors in the S&P this year because of that focus on dividends. Other areas are companies with debt, and especially floating rate debt. As the Fed cut 50 basis points, immediately you have a lower interest cost on that debt. But to your point, David, one of the conundrums people saw was you kind of assume mortgage rates would fall overnight 0.5% when the Fed cut rates, and it just wasn't the case, right? And that's just because intermediate and long-term rates didn't move very much. They actually went up a little bit after the Fed cut interest rates 50 basis points. And it's just the chicken and egg of that kind of being priced in the markets. Now the challenge looking ahead is, does the Fed want intermediate and long-term rates to be a little bit lower or not? And that's going to be determined by, as always, supply and demand in the market and the overall economy.
Yeah, Jared, I think the case for dividend stocks is becoming more and more compelling because, again, some of that may have already taken place. And as you said, interest rates in some cases jumped immediately after the announcement. But over the course of the quarter, they've been trending down and down. You saw the same thing with mortgage rates. In the previous recording, we talked about it. Mortgage rates had been trending down. And then, when you had the rate cut, they actually jumped a little bit, but still, on a trajectory towards low rates. I'd say the case for high dividend paying stocks is there because just a couple components. One is, as you mentioned, as rates come down, people will look to generate income in other areas. So as interest rates move lower, some of that cash will be put to work in high dividend paying stocks, real estate, other areas. You do have more of a value bias in the high dividend paying stock names. So again, they're paying out dividends because there's not a huge opportunity to reinvest that in their own company for growth. So they pay that out. And as a result, if we see a rotation and value continue to perform well, high dividend paying stocks stand to benefit. And then lastly, there's a lot of commodity producers in there as well, and some relatively stable value companies that, again, either iron ore or other natural resources, energy and the like. So those, again, you could see benefit as as China continues with their stimulus and continues to try to drive some additional demand. I would say, there's definitely some geopolitical risks that we see out there, both in the ongoing war in the Middle East as well as the ongoing war in Russia. So that could also, drive commodity prices higher if that continues.
Well, and looking ahead, David, the fourth quarter in October, historically a pretty volatile month. But when you look at, kind of the drivers ahead, that you really have this feeling of a Powell put and the rotation happening in the market. The Fed put, meaning if things do slow down, the Fed could cut more aggressively to accommodate the markets a little bit. The other challenge you have is, we think we're entering this phase is, what's going to happen if we have good economic data or good economic news? Is that going to be good news because it's good for the economy, or is that going to be bad news because the Fed may cut a little less? Or on the other side, if we get bad economic data or bad jobs data on Friday, is that good news because the Fed will cut more aggressively, or is that bad news because it's a slowdown in the economy, and that might have been the reason the Fed cut interest rates aggressively is seeing some of that slowdown. So it's good. These are going to be the things to watch, and then third quarter earnings should be solid, given what we've seen in economic growth. But to me, I still think we're kind of entering what I've been calling the boring phase of this, cycle of where we are in the economy, and that being where economic growth is leveling off a little, inflation is coming down, the Fed's cutting interest rates, the job growth is leveling off. And when you look at that type of market, the breadth of the economy, the value stocks should continue to perform a little better in that scenario, just because the valuations on the highest companies are, a little bit stretched if we're entering that slower phase. So with that, we want to thank you for tuning in this month, and we'll see what happens in November this month.
Thanks.